Hello everyone. So guys, we are going to discuss today one or two long questions, okay, regarding investment decisions. And through the questions, we will learn that how to calculate net present value. We will also learn how to calculate internal rate of return. We will also learn how to calculate payback period. We will also learn how to calculate profitability index, etc. Okay, through the help of questions. So because it this kind of questions can appear in your essay or long style questions. Okay, so this unit is really important. So here we go. We are starting with the question number one. So here we have question number one now on your screen. So we have here Hasman company plans to plans to replace an old piece of equipment that is obsolete and expected to be unreliable under the stress of daily operation. So actually we are going to replace old piece of equipment. Maybe we are going to buy the new one. So the equipment is fully depreciated. So this equipment is fully depreciated and no salvage value. So we don't have any salvage value of old equipment. Okay. Otherwise, we calculate after tax proceed from the sale of old equipment, which will be the part of initial investment, right? So here we go. So then they're saying, and no salvage value can be realized upon its disposal. So one piece of equipment being considered, like the new equipment which you are considering now, as a replacement will provide an annual cash saving. Whenever you will see annual cash saving word, so it means it's a cash inflows, right? So or he may use the straight away the word cash inflows. Okay. So but here he told you it's an annual cash saving, which is considered as a cash inflows of 7,000 before income tax. So from this amount, tax is not deducted. So we have to deduct the tax while we'll solve this question. Okay, so this is annual saving. And without regard to the effect of depreciation. Like they're saying this 7,000, which is per year you will get. So there is no effect of taxation in this amount. So that tax you have to consider. And there is also no effect of depreciation has been taken into this amount. Okay, so it means these cash flows are before tax and before depreciation effect. The equipment cost is $18,000. So this $18,000 is your actual initial investment, which you will invest into this equipment, okay, to replace the old one, and has an estimated useful life of 5 years. So it means we can assume here one thing. What we can assume? So the annual cash saving which is given 7,000, which is before tax and depreciation. So this amount you will get for 5 years. Like in year one, you are also getting 7,000. In year two, you will also get 7,000 in year three, four, and five. Okay. So no salvage value will be used for depreciation purpose. So they're saying that usually, well, when we calculate the depreciation, and please remember we always use the initial cost of the asset to calculate the depreciation, which is 18,000 here. And usually we don't consider salvage value, okay, because it is not accepted by tax authorities. So then they're saying that because the equipment is expected to have no value at the end of year five, and he told you also why we are not considering salvage value. He told you the reason for that also, that because it will not have a value, any salvage value at the end of 5 year. Okay, so salvage value is zero, and usually when we calculate any depreciation for tax purpose, so we don't consider the salvage value. Then Hasman uses the straight line depreciation method. So this is the depreciation method. So because these cash flows are given, 7,000 is given before depreciation. So obviously we'll include the effect of depreciation also. So we are using which method? Straight line method. Okay, then. So this straight line method we are using on all equipment for both book and tax purpose. They're saying for book means accounting purpose, for tax purpose mean to say we are also using the same method for the tax purpose. Hence, annual depreciation. Hence, the annual depreciation is 3,600. How you got this depreciation? I'm just showing you calculation because your cost, because whenever you calculate depreciation, we need cost of asset, which is given as 18,000 as initial investment. And we have to divide with the number of years or life of the project. And project is having a useful life. Our equipment is having a useful life of 5 years. So we'll divide with the life. Okay. So which is 5 years. So if you will divide here 18,000 over 5, so you will get depreciation per year, which is going to be 3,600. You can just cross check your calculation. Okay. So then guys here, what else information we have here? The company is subject to a 40% tax rate. Yes, we need a tax rate because we have to adjust these cash flows for tax purpose. Hasman's desired rate of return is 14%. So this is actually the cost of capital we will use, and we'll pick the discount factor at 14%. So it will use 14% column for present value table. This is just information is given. Obviously, as I told you, this is a cost of capital. Okay, our investor required rate of return or desired rate of return. So at least company want to make minimum 14% from here. Okay, so now here we have a other information. So this is the complete question. Now let's start with the net present value calculation. First, we are going to work with the NPV. Okay, to calculate the NPV, guys, we need actually three kind of cash flows. We need initial investment, which is given here 18,000. Okay. And I told you when we studied relevant cash flow, sometime initial investment will include the amount of working capital also. It may also include the after tax proceed from sale of old equipment, which is also not given in the question. Only initial investment is given 18,000. Then we need after tax cash flows. We need after tax operational cash flows we need. Okay, so that will regarding this after tax cash flows, we have information here about of 7,000, which is before tax and depreciation effect. So that will calculate. Okay, this we will calculate now. And third, we have a project termination cash flow. Project termination cash flows, third type. Okay. And usually project termination cash flows include what? Recovery of working capital. Working capital is not given here in this question. And it also include sale of this equipment, which you bought in now for 18,000. Maybe you may sell this equipment by the end of the life of the project. Okay. So again, you need their after tax proceed from the sale of new equipment. Okay. So, but again, he told you the new equipment is having a zero salvage value. Okay. He told you here, right? He told you here there is no salvage value, expected value. Okay, no value at the end of year 5. Now here, initial investment is given. Project termination cash flows are not given, but information about after tax cash flows are provided. So here we go. We are going to do now a calculation for after tax cash flows. So how you will calculate? So please remember here, guys. Actually, this working we can use for year 1 to 5 because every year we have what annual cash saving is given 7,000 in the question. You can just check it here. It's given here 7,000 because it's an annual cash saving. I told you annual cash saving we always consider as what? Cash inflows. So we have a cash saving of 7,000. So first we'll write that. So what we are calculating? We are calculating after tax cash flows we are calculating. And these after tax cash flows, okay, should include the effect of taxation also and the effect of depreciation also. Whatever the tax saving you will get on the depreciation. So I'm going to show you two ways how to find out the after tax cash flows. This is the first way of that. Then I'll show you alternative working also for after tax cash flows. Okay. So here we go. First we'll write it here annual cash saving, which is 7,000 given in the question. From there, we can deduct what? Income tax. Because this is the cash savings, so we have to pay tax on that, right? So tax is how much? 40%. It's given in the question, this rate. So what we'll do if I'll take 7,000 multiply by 40%. Okay. So this will give you tax amount of 2,800. So this we will deduct. So this is called now after tax cash saving. Please remember here, so far, whatever amount you got it here, 4,200, which is after tax cash saving. Okay, so here we have considered the fact of tax, but we have not considered the effect of tax saving on depreciation. On depreciation, for the tax purpose, which is called also capital allowance, so we can deduct, right? So and that capital allowance obviously will give you some tax saving. How? Because if you will write this depreciation as expense, which is I'm saying tax depreciation as expense, so it will reduce your taxable profit. Due to that reduction in taxable profit, you will get some tax saving. So that is the second thing we need to work out now. So we need to calculate tax saving on depreciation, which is also called depreciation tax shield. How you will calculate? First, we need to know what is the yearly amount of depreciation. So first we'll calculate the depreciation here. So first we'll take historical cost of the equipment, which is 18,000, and we'll divide with the useful life, which is 5 year. Okay, so this will give you what? Annual depreciation. So this depreciation is the same in year 1 also, 2, 3, 4, and 5. Understood? So we have a 18,000 is the cost, life is 5 year. So if you will divide with the life, so you will get depreciation expense. Now what we'll do? So now we can calculate depreciation tax shield, which is also called tax saving on depreciation. How you will calculate? You will take annual depreciation multiplied by tax rate. Annual depreciation multiplied by tax rate. Oh, so this, for example, annual depreciation was how much? 3,600 multiplied by tax rate. Tax rate was 40%. If you will take 3,600 multiplied by 40%, so depreciation tax shield is 1,440. So this is actually tax saving due to depreciation. So this will be added with after tax cash saving. Okay, so if you will add these two values, so this is called annual after tax cash inflows, final value, which you will take it to the net present value calculation. Okay, guys. So what we have done, just look at one more time. So we wrote annual cash saving, which was 7,000. Then we deducted tax of 40%. So you got after tax cash saving. Then we need to get this value, depreciation tax shield. For that, first we need to calculate amount of depreciation. How you calculate the amount of depreciation? We need historical cost divided by useful life. We got the depreciation. This depreciation per year should be multiplied with the tax rate. This will give you tax a shield, a depreciation tax shield, a tax saving on depreciation. So this value we will add with this value. So this will give you what? This will give you after tax annual cash inflows, which is 5,640. Please don't forget these cash flows are from year 1 to year 5. Okay, so now I'm showing you other way. This is the first way we can follow. Second way, same result we will get by following another way. So another way is what? This is alternative working. So again, these cash flows we are calculating after tax cash flows, okay, for from year 1 to year 5. So what we'll do, we'll take annual cash saving, which is given in the question as 7,000. So from there we'll deduct, this is the alternative way, okay? We'll deduct depreciation itself. And we have a yearly depreciation of 3,600. Okay. Then what? We'll Once you will take annual cash saving minus depreciation, you will get what? Profit after depreciation you will get, which is 3,400. Now what we will do? We will deduct tax 40%. Like we'll calculate first profit after tax depreciation. Then we'll deduct that 40% tax, which is 1,360. Right. And then we'll add back depreciation. You know why we are adding back depreciation? Because depreciation is your non-cash based item. So we have to add back. It has no cash outflow. But here, why depreciation is deducted here? Why? Why it is deducted? Because it was just due to the calculation of tax we deducted as expense. But then why we added back here? We added back because it is a non-cash based item. So that's why we have added back. And once you will follow this format again, you will get what? After tax cash flows you will get, which is also how much? 5,640. I hope so it is clear. So I hope so, guys, it is clear. Then this alternative calculation I have already explained to you guys. Okay, first thing I also told you. So these are the annual cash flows from year 1 to 5. Okay, so we calculated this way. You can see this format how it is calculated, and you can also check this format how it is calculated. So both are alternative calculations. Okay. Now, guys, now we are going to calculate net present value. How you will calculate net present value? You know, our cash flows are constant, right? Our cash flows are constant from year 1 to 5. So how much annual cash flows? 5640. So now we can calculate NPV by using two way. First, I'm going to tell you the long way. How you will calculate NPV? So we'll write it here. This is alternative working, guys. So first we write year. As per project life, we have a year 0, 1, 2, 3, 4, 5. And in year 0, we will always write investment. And our investment was 18,000, if I'm not wrong. Okay. It's given in the question. So it is always written as a negative cash flow. Okay. And please remember this, whatever format I'm explaining now. So this you can use in both scenarios, even if your cash flows are even or your cash flows are uneven. Uneven means what? Uneven means, say, for example, in year 1, you have a 10,000 cash flows. In year 1,000, in year 2, you have a, let's say, 1,500. In year 3, you have a 3,000. So this is uneven. Or if even cash flows are even, so you can use this format. Okay. So even means like you can see your cash inflows are constant in every year. Okay. In both scenario, you can follow this format. So we'll write it here, cash inflows. In year 1, we have a 56,402, also same amount. In year 3, we also having same amount, year 4 and 5, so on. Okay. So then we'll multiply with the discount factor. He told you cost of capital is 14%. Now the point is that from where you will pick these cost of capital. So obviously you will go to the present value of $1 table. When you are following this format, so you have to go to present value of $1 table. Okay, so I'm showing you table. So this is the table of present value of $1. So here you have to, this is the present value of $1 table, this one. So what you will do, guys, you will go to 14%. So this is still 10 and we have here 14% also here. Okay, and we'll pick the present value factor for year 1, 2, 3, 4, and 5. So these 5 factors we will pick. Okay, and we'll write it there. But please make sure this is starting from year 1 to 5. Okay, we'll go back to the question. So please also remember in year 0, present value factor is always 1 because today 18,000 is equal to 18,000. But for from year 1 to onward, you can find this from the table. These are written in the table. And now what you will do, you will simply just multiply these cash flows, which are after tax cash flows, okay, with these factors. You will just multiply. So once you will multiply, this is called what? Present values now. So 18,000 multiplied by 1, it is 18,000 negative because it's investment. Then if you will multiply 5640 multiply by 0.877, you will get this value. Then you will multiply these two values, you will get this value. Then you will multiply these two values, you will get this value and so on. Okay, so you will complete it. Now guys, here, this is called your, this year 0. This is called your present value of outflows. And from year 1 to onward, so these are called what? Present value of inflows. Now, if I will net off these two value, net of these two value. So this is called what? NPV. So what is NPV? So it's a present value of outflow and present value of inflow. Once you will net off these two values, so this is called NPV, right? So or simply you can write this way: present value of inflows minus present value of outflows. So it's equal to your net present value. Okay. So once you will do plus minus here, for example, so all these are the positive value you will add, and this value is a negative, you will deduct. So you will get it here positive NPV because answer is positive. Whenever NPV is positive, it means your inflows are greater than your outflows. And in that scenario, NPV will be positive. And if NPV is positive, we will always accept the project. And if NPV is negative, so it means it's a loss, we will reject the project. Positive NPV implies that there is a profit. Okay. So the NPV calculation first way. And I told you this way you can use present value of $1 table in both scenarios if cash flows are even or uneven. So there is a one more shortcut is here for NPV calculation. So net present value. So how you will calculate here? So here I'm using here another table. That table is called present value of ordinary annuity table. Ordinary annuity table. Please remember this shortcut you can use only in one scenario if cash flows are even. Even means, say, for example, as you can see here, we have every year cash flows 5640 from year 1 to 5. So this is called even cash flow. It's not different. It's same every year. So in that scenario, you can use this table and there is a shortcut to calculate net present value. And how you will find NPV. So first of all, NPV, how you will calculate. So this, if you will look at here, this side, so this side is called present value of inflows. And this is called your present value of outflows. So how you will calculate present value of inflows? By using present value of ordinary annuity table. So you have to take after tax cash flow. Please guys remember here, when you take after tax cash flow, you have to pick only yearly value per annum. Don't take it like that 5640 multiplied by 5. No, just yearly value you have to pick. So 5640, which is after tax cash inflows, multiply by present value of the annuity. Now you will go to the annuity because your cost of capital is 14% and your project life is 5 years. So you will, what you will do now? So you will go at 14% and look for year 5 annuity factor. And you will go to ordinary annuity table. I'm showing you here. So this is the table present value of ordinary annuity table here. Okay, ordinary annuity. So I'll go to 14%. This is 14% and look for year 5. So value is how much? 3.433. So here we go. But they have used up to only 2 decimals. They have used only up to 2 decimals. They took 3.43. But in table it's written 3.43. So you can use up to 3 decimal. It's your choice. So now if you will multiply after tax cash flow, which is 5640, multiply by present value of an ordinary annuity, which is 3.43. So this will give you present value of cash inflows if you will multiply these two values. So present value cash inflow is 19,345. And then you have to deduct from here present value of outflow, which will be your initial investment only. That's it. Because initial investment is 18,000. Today you are investing in year 0. And you will always multiply with the 1 because today present value factor is 1. So it will be 18,000. So that's why simply it's written net investment. Deduct net investment of 18,000. So from you will deduct net investment from present value cash inflows. So you will get NPV. How much? 1345. And you can see here there is a slight difference. Here we got 1345 positive NPV, but here we got 1356. It's just the difference due to rounding off because here we used present value factor up to 3 decimals and there we used annuity factor up to 2 decimals. You can see here. Okay, that's why it's slightly different. But these are two ways. Okay, I hope so it is clear. Please, annuity table I told you can use only if cash flows are constant. But present value of dollar one table you can use in both scenario if cash flows are constant or not constant. Constant means even, not constant means uneven. Now NPV we got based on NPV what project should be accepted. Why? Because NPV is positive. Now guys, we are using same data of the question and now we are going to work with the internal rate of return, right? We already studied the full lecture on internal rate of return. I told you internal rate of return is the rate at which the NPV of the project will become 0, right? Or in simple words, it is the return which we expect from the project based on the cash flows. Okay. And how to calculate an IRR? Again, I'll show you two ways. First way, which I'm going to explain now, the first way, which I'm going to explain now. So this way you can use in both scenario, even if cash flows are even or cash flows are uneven. In both scenarios, you can follow the way which I'm explaining now. Okay, and then I'll tell you if cash flows are even, we have a shortcut way also to use it. So first I'm explaining long way. So the long way can be used in both scenarios, even the cash flows are even or uneven, constant or unconstant, non-constant. Okay. So here we go, guys. So here we go. Now, please, to calculate IRR, how you will find out? Guys, we need actually two net present values, two NPVs we need, by the way. And what is the rule? First, we will calculate normal NPV. First NPV, we will calculate normal. Normal means whatever the data is given in the question, same data you will use. And by the way, you have already calculated, right? Normal NPV. Normal NPV means you will use the cash flow which are given in the question and you will use the cost of capital which is given in the question and find the NPV. So that is first NPV. And first NPV we have already calculated. And what was the first NPV? If you don't forget, first NPV was uh, 1356 by using this way, or 1345 by using this way, right? A slight difference is there because round due to rounding off. So I'll take this NPV, okay, as my calculation shortcut. So first we will calculate the first NPV, which is already calculated NPV. So we have first NPV at which rate? At 14%. Okay, 14%. We used annuity table, right? We took after tax cash flows multiplied by annuity factor. So after tax cash flows were 5640 from year 1 to 5. Annuity factor was 3.43 at 14%, at 14% for 5 years. This factor we took. Okay. Okay, so this is called present cash inflows and minus net investment, which is 18,000. So you got a first NPV normal 1345. This is called normal NPV. Now, please, here normal NPV is positive. You know what does mean the positive NPV? Positive NPV mean to say our return is more than 14%. Actually, we are earning more than 14% because at 14% our NPV is positive. It means we are earning more than 14%. Now what we will do now, guys, we have to calculate second NPV. And to calculate second NPV, cash flows, we will use the same cash flows. But only what we will do, we will change this cost of capital. In first NPV, we use the original cost of capital, right? In second NPV, what we are going to do, we are going to use uh, assumed rate, which is 18%. Now let me tell you 2 points here. If first NPV is positive, right? So we need second NPV, negative NPV. To calculate negative NPV, we will always increase the cost of capital. You can assume any rate, but at least increase by 5-6%. Okay. For example, initially if it is 14%, so I'm assuming now rate is 18%, right? Because my first NPV was positive, so I need negative. To calculate negative NPV, we will assume the higher cost of capital than the first one. But if the first NPV is negative, for example, in case, so we need second positive NPV. To calculate the second positive NPV, we will assume the lower cost of capital as compared to the first NPV. Okay, so in short, whenever you need second negative NPV, we will increase the cost of capital. And whenever you need second positive NPV, you will decrease the cost of capital. So what is the scenario here? Here, first NPV is positive. So we need second negative NPV. So that's why we will increase the rate. So what rate we are assuming? Let's say we are assuming that rate is 18%. So how you will now calculate the NPV? So formula we are writing NPV. First, we'll take after tax cash flows, which is 5640, multiply by present value factor. We have to take annuity factor, you have to take at 18%. At 18%. Okay. So this 18% you will go to annuity table. Go to annuity table. So this is the annuity table. Okay. This is the annuity table, by the way. Okay. Annuity table. See, it's annuity table. So we'll go to the annuity table and go to the 18%. This is the 18% column. And because this project life is 5 years, so fifth year value is 3.127. So this is what we are taking, 3.127. So it is multiplied here 3.127. Okay, so this will give you present value of inflows. From there, you will deduct what? Net investment, which is 18,000. So now you got negative NPV. Now, please remember, negative NPV implies that our return is less than cost of capital. It means our return is less than 18%. But at 14% NPV positive. So positive NPV implies that our return is greater than 14%. It means our return is greater than 14%, but is less than 18%. So it means our return is in between these two. Because at 14% our NPV was positive and 18% NPV is negative. It means our return is more than 14 but less than 18. It means it's in between. So now how you will find that from point, like what is the exact IRR? So we will apply the formula. So what is the IRR formula? Please remember here. So we'll take here first lower cost of capital, which is a 0.14, because there are two cost of capital we have used, right? 14 and 18. So lower cost of capital, L stand for here, lower cost of capital, which is 14%. Then NPV at lower cost of capital. NPV at lower cost of capital is how much? 1345. Divided by NPV at lower cost of capital, which is 1345. And minus in the formula, and minus we have to take now NPV at higher cost of capital. At higher cost of capital, NPV is negative this, right? So that negative and the negative in the formula will become positive now. It will become positive now. Okay. So what then we have to take NPV at higher cost of capital. NPV at higher cost of capital is how much? 363.72. Okay, we'll write that 363.72. Okay, and then what it is higher cost of this will we will multiply now higher cost of capital, which is 8.18 18% minus lower cost of capital 0.14. Now we'll solve it. So well, what we'll do, this is 14%, this value, and if I'll solve these two first, if I'll add these two values, so the total will become how much? It's by the way, total will become how much? 1708.72. And what was the numerator? Numerator is 1345. So what is the formula? 0.145. This will bring it, we will bring it here. So the numerator is 1345, this value. And the denominator is the summation of these two is this, divided by this. And multiply by the difference of these two values, 0.18 minus 0.14, it is 0.04. Now we'll solve further. So 0.14 will bring it here. Now we'll solve this equation. So we'll take 1345 divided by 1708.72. So you will get this answer 0.7871. And then you will multiply this with 0.04. Now what? We'll do the multiplication now. This will multiply now these two values. Now, once we'll multiply these two values, you will get 0.031484. And you will add here plus 0.14. Okay. So once you will add these two values, you will get something. Then you will multiply with the 100 to get the answer into percentage. And once you will get the answer into percentage, so your IRR is how much? 17.15%. It means, see, it means at 14%, our NPV was positive, right? So it means our return is greater than 14%, right? But at 18%, we calculated NPV, our NPV was negative. Okay, negative. So it means our return is less than 18%. So then what is our return? So our return is 17.15%. Now, one more thing. It means if you will use this as a cost of capital, 17.5, like don't change the cash flows, 56400 is your annual cash flows, initial investment is 18,000. If you will discount this value at this rate now, okay, so your NPV will become zero. So this is called that, this is the definition of IRR actually. You don't need to prove this, just you have to calculate IRR. Okay, I hope that is clear. Now I'm going to tell you there is a alternative way which we can use for IRR calculation. This is shortcut way, and sometimes this will help you. Okay, so how you will use this shortcut way, guys? How you will use? Please remember this shortcut cash flows are even. If cash flows are even, only in that scenario we can use. And we know our cash inflows are even, which is 5640 from year 1 to 5. Right or wrong? And we have initial investment of 18,000. So these are even cash flow scenario. Like every year we have a 5640. So if this is the scenario, so then there is a shortcut way to calculate the IRR. Okay, how you will calculate? First, you will apply this formula. What's the formula? You will take initial investment divided by after tax cash flows. Initial investment is 18,000, right? Divided by and after tax annual cash flows we need, which is 5640. So you will get answer 3.19. Now this factor. Now once you got this answer, initial investment divided by after tax cash flows. So once you got this answer, now this value, you have to look into the annuity table. Annuity table, ordinary annuity table, present value of ordinary annuity table. And how you will look now, guys, please remember here, how you will look. So this is the way I'm going to tell you here now. Then I'll show you what's written here. I'll go to the annuity table. This is the annuity table. Okay, to find the IRR. I'll just select because I have to look my life of the project. Life is 5 years. Now I'll just go through the row of 5 years. So this is the row of 5 years. Year 1, 2, 3, 4, 5. So I'll go through 5. And I have to search where is written 3.19. Because 3.19 was this value, right? Which we calculated here by taking initial investment divided by after tax cash flow. We got 3.19. This 3.19, I want to look here where in the annuity table in front of year 5 it's written 3.19. So see where it's written 3.19. Is it written here? 3.19. No, because this is up to 10%. So let's search next one also. Here we have a percentage 11, 12, 13 till 20. And again, year 5 we have here. We'll search 3.19 where it's written 3.19. So see, Here it is written 3.19. Right or wrong? 3.19. It means our IRR is approximately 17%. Now 3.19 is written here annuity factor, right? So now you will see what is the percentage on that. So percentage is 17%. Means our IRR approximately is 17%. Understood? And we calculated in the long way also. And now we applied the shortcut way also. So our IRR is 17% approximately, I'm saying. Understood? But the first way is the more authentic. This is the shortcut way just to answer your question. Okay. I hope so it is clear, right? So these are two ways I told you how to calculate IRR. So first way is what? What I told you in the first way. First calculate first NPV. If it is positive, then you need second NPV. That should be negative. Okay. Or if first NPV is negative, so then second NPV you should need positive. Okay. You should have positive NPV. If first is positive and you need second negative NPV, always cost of capital will be increased. If first is negative, you need positive NPV, always cost of capital will be decreased. Because second NPV we will always calculate by using assumed rate. And there here you have to increase the cost of capital, and here you have to decrease the cost of capital. And once it is calculated, then you have to apply the IRR formula. What is the IRR formula? You will take lower cost of capital uh, plus NPV at lower cost of capital divided by NPV at lower cost of capital minus in the formula NPV at higher cost of capital, and then multiply by higher cost of capital minus lower cost of capital, right? This is the IR formula. And then the shortcut way I told you. Shortcut way is what? Don't forget, if cash flows are even. So first take initial investment divided by after tax cash flows per year. So you will get answer. Okay, that answer look into the annuity factor. And annuity factor, how you will search, you have to look project life. What is the project life? Life is 5 years. Okay, so you have to search in the annuity table the row of 5 years where that this value is written, and then look into the percentage. What is the percentage under which this value is written? So that will be the IRR. Understood? I hope so it is clear. Now, guys, we are going to calculate how to calculate the payback period. Please remember here, payback period. Again, for the payback period, we have two scenarios. So what if cash flows are even? Yes, in this question, cash flows are even because every year you are getting $5,640 after tax, and these are even for from year 1 to 5. So if cash flows are even, how you will calculate simple payback? Simple with even cash flow. This is a shortcut way. So how you will calculate payback? So you will take net investment divided by after tax cash flows per annum. So same thing we applied in the IRR formula just now. Actually, that was the payback period. Okay. And payback period, how you will calculate? So we'll take here 18,000 divided by 18,000 is your net investment divided by after tax cash flows. Okay. So this, if you divide, so it means this is 3.13. So please remember here, I skipped one thing that I'll also explain, but let me complete it here. So this is the payback period. So this payback period means your project will take 3.19 years to recover the cost. That is called payback period, right? What is payback period? It is the period that the project will take to recover the cost, like how long a project will take to recover its cost. So it will take 3.19 years. And usually if payback period is less than, this payback period is less than project life or target payback period. Sometimes management may give you target that invest only into those projects where you can recover cost in 4 years. So if your this payback period is less than project life or the target payback period, whatever is given, so we will accept the project because we are recovering the cost within the target. But if this period is greater than life of the project or target cost of capital, obviously then we should reject the project. Okay. So this is payback period. Now, guys, please remember a payback period can be calculated this way also. So now the way which I'm showing you this way, you can use in both scenario, even if the cash flows are even or if the cash flows are uneven. So this way you can use. What is the way? So you will write years first. Okay, we have year 0, 1, 2, 3, 4, and 5. And then this is second way I'm telling you. This way you can use in both scenario. Okay. So we'll write it here after tax cash flows, which we have already calculated. So in year 0, we have an investment of 18,000. In year 1, we have a 5,640. Year 2, you also have a 5,640. Year 3, you also have a 5,640. Year 4, you also have a 5,640. And year 5, you also have a 5,640. And now we will create a remaining investment column, that how much investment is remaining. Now how you will, this is how you will think. How you will think, guys? So you, in year 0, you have a remaining investment of 18,000. After that, you have recovered in year 1, 5,640, deduct this one. So 18,000 minus 5,640. So remaining investment is still, we have 12,360. Okay, again, you have, out of that, you have recovered 5,640 in year 2. So minus 5,640. So still we have a remaining investment of 6,720. Okay. And from there, so again, you have a remaining investment, and then you have recovered again in year 3, 5,640. So deduct here minus 5,6. Okay, 40. So you got remaining investment how much? 1,080 still remaining. Now you can see a remaining investment is less and cash flow in the next year is more. Whatever, whenever this scenario is there, so you will apply this formula to calculate the fraction of year, because year 4 we don't need complete, because we need to recover only 1,080. So, but in the cash flow in the year 4 is more, which is 5,640. So in that scenario, it means we maybe spend just fraction of the year 4 to recover this cost, right? So how you will calculate the fraction of year 4? So you will just apply the formula, take the remaining investment, which is 1,080, divided by cash inflow in the next year, which is 5,640. So if you will divide, I believe, so what it is, 1,080 divided by 5,640. So it will give you 0.19 year. It means we took year 1 complete because there is a remaining investment at the end of year 1. We took year 2 also complete because there is a remaining investment at the end of year 2. We took the year 3 also complete. It means because there is a remaining investment. But in year 4, we recover the cost, right? Whole cost. It means we took 3 complete years, plus from the year 4, we took 0.19. So it means our payback period is 3.19 years. Okay, this is how you will calculate this payback period. I hope so it is clear, right? And then one more thing, guys, let me tell you here. If in exam, see, please remember here, I told you, this is the summary I told you. I told you payback when you calculate the payback period. So you have to check if cash flows is even. So you can apply this formula. Okay, to calculate the payback period. What is the formula? Initial investment divided by cash inflow, okay, per annum after tax. So initial investment is 18,000. Cash inflow per annum is 5,640. So this will give you payback period. Okay, but I told you other way. Other way is that even if the cash flows are even or uneven, so this approach you can follow in both scenario. Okay, there you will create this column. You will write ES. Okay, then you will write here in cash flows after tax, and then you will calculate remaining investment as just we did now. Okay, we will calculate remaining investment, and this is how you will calculate the payback period. Okay, so these two payback periods are called simple payback period. Which one? Simple. Okay, because we did not use the discounted value. So simple cash flows we use, simple payback period. So with even cash flows and with even or uneven cash flows, I told you, right? But there is a sometime they may ask you how to calculate discounted payback period. Which one? Discounted. It means how you will calculate discounted now. Discounted means say you have to use present values instead of normal cash flows. We need discounted cash flows. And how you will calculate? I take you to the NPV calculation one time, because there we have a already present value. See, for example, now I'm talking about how to calculate discounted payback period. Please remember, guys, here. Discounted. Yeah, obviously, this is another type of payback period. If you are calculating discounted payback period, obviously it will be different than simple payback period. How you will do it? To calculate the discounted payback period, you have to do this thing now all together. Actually, first you have to calculate present values. First step, you have to calculate present value to calculate the discounted payback period. And how you will calculate present value? We'll write year 0, 1, 2, 3, 4. We'll write cash inflows, which is 18,000 in year 0. Then we have a 5,640, 5,640, 5,640, 5,640, 5,640, and multiply by 14% is the cost of capital. So we take all, we in year 0 it is always 1. Present value factor is 1. From year 1 to 5 we'll take from the present value of $1 table, right? We'll use that. And then we found the present values, right? So we found the present value after multiplying these values together. So we got present values column. And now this value we don't need. But this column we need. Now we'll create remaining investment here. And we'll see this way. How? In year one, we have here remaining. In year zero, sorry. In year zero, we have a remaining how much investment? 18,000. Then how much is recovered? This much is recovered. So you will just go apply now. So 18,000. Okay, minus, I'm using rounded value. Okay, minus 4946. Okay, so it is remaining investment is still 13,054. I'm using rounded value, guys. Then from 13,054, we recover this much value. Again, we'll deduct minus 4337. So we have still remaining investment. How much? 8717. Again, we recover this much value minus 3807. You got a 4910 as remaining investment. Still, you recover this much value in the next year. So minus 3338 or 3339. I'm just using rounded value. So 1571 still remaining. Now we have a 1571, and now cash inflow in the next year is more. Still, we can calculate the fraction of year 5 which we took. How we'll calculate? We'll take remaining investment 1571 divided by cash flow in the next year, which is 2927. So 2927. So fraction is 0.53. Guys, just cross check calculations, okay? Because I'm doing on calculator, I may make mistake. So it means we have now how much payback period we took? We took all 4 years complete, because till the end of 4 years we have remaining investment. And from the 5th year we took this portion. It means our payback period is 4.53 years. This is the payback period. And obviously, when you calculate discounted payback period, your length of payback period will increase, okay? Because we are using discounted values, and discounted values are always smaller than these values you can see here. For example, here it was 5640, it is equal to 3338 today due to time value money concept. Understood? Okay, now guys, so payback period is also fully revised. Now I'm going to tell you profitability index. So I told you guys, in capital rationing situation, we calculate profitability index to rank the project. And what's the formula for profitability index? But if you want to go through the whole concept of profitability index, okay, then you have to watch that video. Okay, guys, which we covered last time. But here I'm just telling you how to calculate profitability index. Let's see, this is the requirement. So there are two formulas are there to calculate the profitability index. First formula is what? We can use present value of future cash inflows, only inflows, and divided by net investment. Now the point is present value future cash inflows. We already calculated this value. Present value future cash inflows. How? We have an annual cash flow of 5640 multiplied by annuity factor. This 3.43. How we got? We our original cost of capital is 14%. We'll go to the annuity table. At 14%, we'll look for 5 years. At year 5, this value is given 3.433 is given like that. Okay. 3.433. So but it is used here up to 2 decimals only. So once I'll multiply 5640 multiply by this is called present value of cash inflows divided by net investment. So this is the present value of cash inflows divided by net investment is 18,000. So this is profitability index 1.07. So there is another formula to calculate profitability index. Okay, so that formula is, you can use this also, NPV divided by initial investment. Do you remember our NPV was 1345, right? At 14%, which is our original cost of capital, and investment is 18,000. So now if you will calculate your profitability index, so answer is 1345 divided by 18,000. So now profitability index is how much? 0.074. And here profitability index is 1.07. See, whenever you take numerator as a present value of inflows, so then answer always will be greater than 1. But if you're taking NPV as the numerator, answer will be start from 0 point something. But please remember, this is the index, means a profitability ratio, you can simply say. And this, due to even you are using this formula, numerator as a present value of cash inflows, it means what I told you in shortcut, I'm saying this. So to calculate the profitability index, So we can take numerator as present value of inflows only, or we can use NPV, anything, divided by initial investment. If you are using this formula, so the profitability index will be greater than 1, greater than 1. But if you're using NPV divided by initial investment this way, so then it will start from 0 point something. Please remember, even you are using this formula or this formula, it is not affecting the ranking of the project. Okay, guys, I hope so it is clear. Rest, to understand the advantage, disadvantage of each method, we have already covered in the previous videos, previous lectures. It's clear, guys. Please confirm.